So let's work on a Husky and Pup. So this is a consolidation in year 6. So we need to eliminate the beginning of 6 retained earnings because we owned it all during year 6. So the revenues and expenses of the subsidiary belong to us. All right, so let's go ahead and start with the S entry to remove the book value of the subsidiary. So that's their common stock, additional paid-in capital, and beginning retained earnings. The only time we do ending retained earnings is on the day of acquisition, and that's not typically a financial statement issue date, so it would be unusual, but possible to have that. So let's eliminate these, and they are eliminated against the investment in. So let's gather those totals up. There we go. Now let's book the beginning of the year book value of the fair value over book of the other assets, the assets that had a difference between fair value and book value. So they tell us here that $7,000 of the purchase price went to land. Well, that is not amortized or depreciated, so it's put on at its full value because in year 1 and 2 and 3 and 4 and 5 it wasn't amortized or depreciated. Now we have $16,000 allocated to equipment with an 8-year useful life. So that means $16,000 divided by 8, that in year 1, $2,000 of that was depreciated. In year 2, another $2,000 was depreciated. In year 3, another $2,000 was depreciated. Year 4, another $2,000. Year 5, another $2,000. So there's been 5 times that $2,000 has been expensed of that 16. So that means all that's left is the 6. So I'll put a little formula in here so you can sort of see where did the number come from. The original 16,000 less 2,000 for each of the 5 years before this year. And then, oh, that was for equipment, wrong spot. Okay, and then they tell you $10,000 was allocated to goodwill. And goodwill is not amortized or depreciated as current GAAP, at least. They've made noises about making changes to that, but that's probably several years off at best. But right now it's just subject to impairment. It is not amortized or depreciated. Okay. So those were the changes, and so the beginning of the year fair value over book value remaining. So that comes out of the investment in account. We want to eliminate the income and subsidiary because they're now going to be one and the same entity, so they can't make money off each other. Was there a dividend? Yes. Okay, so let's eliminate this dividend, credit it off, and debit the investment in, which is where it was recorded when it was paid, and we have to reverse it. And, oh, let's amortize that equipment for this year. That's $2,000 a year, so we have 1 year's worth. And we'll put it in operating expenses because there's not a separate line for depreciation and amortization. All right, so let's see, did we catch it all? All right, let's check our debits and credits. We should have done that at the beginning. I keep forgetting to do it on these videos for you. Okay, good. So now we can start doing the math again. And so for many of the lines, it is just what we call a crosscast, which is a horizontal sum. But there are some that are vertical, and net income is one of the vertical ones. And net income comes from above, and then retained earnings is one of the vertical ones. Because I haven't done the subtotals here in the consolidation entry, I've just booked the entries, so we can't rely on those subtotals for adding across. All right, and these all work. The investment one doesn't work because all of this is actually one line. We put it on 3 lines so you can see all the activity. It makes it a little easier to see exactly what happened. Hopefully that zeroes out. It does. Total assets are vertical. All right, let's see. Retained earnings comes from above. Okay, and vertical, and let's see how we do. And now the balance sheet balances. So there you go. Ready for the next.